Well, in business news, Indonesia's central bank has cut its key policy rate for the third time in a row, a move that caught many economists by surprise. It comes just hours ahead of an expected quarter-point rate cut by the U.S. Federal Reserve. Bank Indonesia cut its benchmark interest rates by 25 basis points, bringing its total policy easing over the past 12 months to 150 basis points. Thus, as the bank says, it's taking an all-out approach to economic growth, as Indonesia contends with weak consumption and uncertainties from U.S. tariffs. Our recent political developments also testing confidence in Southeast Asia's largest economy, with investors pulling more than $650 million from Indonesian equities this month. And Radhika Rao, senior economist from DBS Bank, joins us now. Ms. Rao, many economists, or all of them polled, were surprised by this rate cut, but you were not surprised.
Hi. So certainly, I think what Bank Indonesia did the last time they met, it's one of the few central banks that meets every month. They did maintain a very dovish language guidance. So we, kind of indicating that there are more rate cuts coming. So it was certainly a matter of timing. I think we had anticipated that they would wait to see what the Fed does overnight and then go ahead and lower rates. Instead, they preempted it by cutting rates by 25 basis points. We do think more is coming. And I think if you see the policy guidance today, really did veer towards giving a lot more weightage to their growth objective and assuming a pro-growth approach rather than just purely look at inflation and repair stability, which is basically their mandated objective.
So if I can break that down, the factors that are exogenous, so for example, the U.S. Federal Reserve, and there are factors that are exogenous and endogenous. So what's happening elsewhere and what's happening within the country in terms of priorities for growth over priorities elsewhere.
Certainly. So, the exogenous factor that you spoke about is what we discussed, which is the Fed's decision, highly anticipated. In fact, it's the matter of debate is whether they're going to do a 25 basis point or a 50 basis point cut. And it does allow many of the Asian central banks to also follow suit. When the US is cutting rates, it does open the path for the Asian central banks to go ahead and cut as well. And you also need domestic reasoning to cut rates. And BI had that. Growth has been facing a bit of downside risks. You've in fact seen the government, undertake the third stimulus package this year. They've also taken some liquidity action. So kind of BI playing its part by lowering rates. And then the governor also spent some time asking banks to mirror that cut. Bank lending rate has really fallen less than 10 basis points so far this year, despite 125 basis point cuts by BI itself. So certainly a lot more room for the banks to transmit that. And a small technicality that they did is that, policy, there is a corridor. They lowered the lower end of that corridor by a bigger 50 basis point. So in effect, all of this put together kind of backing their pro-growth stance at this meeting. So certainly domestic factors as well as exogenous, that's the external factors playing into their hand, allowing them to lower by 25 basis points.
But concerns, of course, that any government would want lower rates because that would be pro-growth. And the central bank, in principle, the independence gives it the opportunity to curb any excess in government sentiment. The concerns now with the new finance minister, rightly or wrongly, that he may not be as much of a curb on any inclinations from the government.
Yes, certainly. I think you're right. Most governments, they would prefer for rates to be low so that the businesses, and the households, for example, could borrow more, they could spend more, consumption generally looks good. So that is what any government would require. But a central bank obviously has a different read. They do have to balance a lot more, things. They need to look at market stability. They need to look at what is their own reading of, growth and inflation numbers. And generally, does that give them sufficient room to cut rates? And I think at this point, certainly what BI is doing is kind of coinciding what with what the government's objectives are as well. So the BI, has been undertaking cuts for, again, good part of this year. They have now done more. We do think there is room to do more in final quarter of the year. All of that towards bringing it together towards, lowering rates and moving to a low rate environment. But from a central bank point of view, certainly the independence in decision making becomes very important. And there was briefly a speculation earlier this week that the parliament could add to the BI's mandate, or they could have a bigger say in the board of governors, their appointment or their dismissal. So that got markets a bit unnerved. But I think since then there has not been much add-on that, and it seems to be something that is just being proposed and studied. But at this point, insofar as the rate decisions are concerned, we do think that the central bank has the room, especially what we call the real rate, which is where the inflation number is and where the policy rates are. If there's a sufficient gap, central banks could go ahead to cut rates. Kind of gives them the room to stimulate the economy if required. So from an Indonesia point of view, they do have sufficient real rate buffer as well.
And a final question, slightly related. The new finance minister has been on the job since the 8th of September. So we've just had a few days of seeing him on the job and the statements that have come out from this new minister. Do we see him deviating much from the known fiscal austerity measures taken by his predecessor? Final question.
Certainly. So, I mean, it's a bit early to, take a full take on what the new finance minister is about. But if we take the read that he has had, the comments that he has made in the first few days in office, it does not look like it's going to deviate too much, especially on the fiscal part. What I mean by that is that he will not put fiscal targets at risk or raise the deficits too much. But it does become clear that he is looking to unclog, growth. So he does realize that if you provide sufficient liquidity, that will kind of be the essential oil or lubrication for the economy. He does see the need that rates in generally should be brought down. He does see the need for demand to be, better. So hence the stimulus package, third in a row. He does have a pro-growth bent. But insofar as the commentaries that came in, we do think he would largely stick with keeping within the fiscal targets. That becomes very important, from a market stability point of view, and also for rating agencies. So what we have seen is actually can be taken favorably.
Thanks for that. Radhika Rao, senior economist of DBS, looking at this latest rate cut by Indonesia's central bank.